Our outlook is called Pushing Limits, and it's really about making sense of large numbers being talked about, and what do we need to believe to justify this huge amount of AI spend. So currently, when we look at the incremental revenue of these big tech companies heading into 2030, end of this decade, they fall short of justifying this huge amount of capex. You know, we're talking about credible estimates pointing to $8 trillion of spend by 2030. Those are huge numbers. So right now, the forecast falls short, but the potential of AI goes beyond existing business lines. So if we have a situation where growth breaks out from the historical 2% trend, never happened before for a sustained period, but now possible because of AI, and also if we have a situation where tech companies keep a good share of the additional revenues being created as tech is applied to other sectors, then the numbers can add up. But you got to believe in some pretty incredible and unprecedented things to justify this unprecedented amount of capex spent.
I'm looking at the Bloomberg Mag 7 Total Return Index, up about 24% so far this year. Are you expecting the same caliber of returns to continue into next year? Do you expect tech to be the leader as we look into 2026?
I do expect concentration first before broader diffusion when we think about the AI trade. We're talking about an environment where there is going to be more leverage, there is going to be more scrutiny over the individual company fundamentals. So if you think about the latest correction in tech and more broadly in risk assets, actually you see greater differentiation, right? You see Alphabet doing better because of the model, Gemini 3 and TPU, and you see Oracle doing a bit worse because of negative free cash flow as well as greater indebtedness. So greater differentiation, concentration before broadening out, and I'm paying very close attention to if there are new revenues being created on top of existing business lines to really understand if the runway of AI is as big as people are hoping for.
If the AI expectations may be ahead of themselves at this stage, are you pulling back from some of those names here? Are you hedging some of that risk here at this point? Are you trying to diversify away from that a little bit?
Well, that's the thing. There is no place to hide. There is no proper diversification in this environment. So one of the key themes in our outlook is diversification mirage. We call it a mirage because the old diversifiers are not reliably working. And this last 24 hours of price action is case in point. So, you know, we look at a seemingly mixed diversified portfolio, and we think that it is proper diversification, but that would be highly misleading because the whole market is being driven by just a handful of singular principal components, and AI being one. So we can't get away from making big calls, active calls on where AI is heading towards, and investment decisions made in the guise of diversification may well end up being huge active bets. So let's make those bets very intentional ones rather than unintentional ones.
So when we think about AI and all the energy that's needed for this, it's going to need a lot of energy. How are you thinking about the energy sector right now?
There is a constraint that is binding already. So as we think about the AI ambition running up against constraints, which is why we frame the outlook on pushing limits, there are three types of limits. One is energy and the physical limit, and we're running up against those limits already. One is financing limit, and right now we actually don't see that being a constraint because even though leverage is going higher and big tech, they have issued $100 million of debt just the last quarter, which is higher than previous years. The starting point is very healthy, right? So there is room to leverage up. There is a feature, is not a constraint at this moment. And then there is the political constraint. We're talking about impact of AI on jobs and what that means in terms of the policy response, regulatory response. So these are the constraints, but right now the one that is binding is energy. So when we talk about credible estimates taking capex forecast up to $8 trillion by the end of the decade, the consideration for energy may well bring that back.
So as we step back and think about 2026, I guess geopolitics, we have to think about that a little bit. We still have an active situation in Ukraine. The Mideast has been quiet for the last several months, but still doesn't feel like that's settled by any stretch of the imagination. And then we have ongoing tensions between the U.S. and China. But it seems like the market's kind of discounted all of that. And I mean, is that something we need to worry about for 2026? Because it seems like a black swan could come out of anywhere.
Yeah, so when we assess the impact of geopolitics on markets, we need to really firmly establish the transmission mechanism, right? So far, a lot of the geopolitical flare-ups have been good opportunity for market participants to buy the dip, and you look at how markets have done, that has been a good strategy. So if we see the impact of a geopolitical event having a lasting effect on oil price, for example, and then feeding through to inflation expectations, not just the 12-month expectations, but maybe even longer term expectations, then there is a proper feedback loop. But if we're talking about a very swift spike and then coming back down, then that's not something, at least from a longer term portfolio construction perspective, we bake that in. You look at geopolitical risk premium is very flat at the moment.